lot of it's going to depend on you and your personal goals and what type of deal it is. If it's a long-term hold versus a quick flip in and out. So let's say we're talking about either a commercial, residential, multifamily property, whatever it is that's long-term and it's a cash flow property. So it just needs to meet your goals for the long term. Generally, an investment that generates an 8 to 10% cash on cash return is considered a good investment. So anything you're looking at that's going to generate a minimum of an 8 to 10% return, most passive investors, that's what they're looking for. That's kind of what the stock market is based on. If it gets you a 10% return over the long haul, that's considered good. Generally, you're going to want to see a double-digit IRR, internal rate of return. That's the return on the investment over the life of that investment. So if you put $100,000 out over 5 years, you want to add up all the cumulative earnings on that investment, divide it by 5 years. That's your internal rate of return. Equity, commercial equity likes to see that. Commercial capital likes to see those returns in the double digits. So it really is up to you. I mean, if you're okay with a 5% return on something, I mean, that's you. That's up to you. It's up to each individual. But generally, by industry standards, you want to see a 8 to 10% return on cash for something that's long-term, double-digit internal rate of returns for if you're raising capital from equity investors. And if you're flipping, if you're buying and selling, getting in, getting out, building spec houses, building commercial spec development, whatever, you generally want to have a 25 to 30% gross margin so you can net 20%. So that's me. I'm an opportunistic investor and developer. So I like to see a 20 to 25% return and sometimes 30% return on my investments. So if you're transactional, if you're opportunistic, you're getting in, getting out, those are higher risk. You want to have a higher return. The long-term cash flow, steady plays, you can have a lower return threshold. But I like to recycle the capital. I like to compound the cash. So I am opportunistic. I get in, get out. And I look for a 25 to 30% return on those deals. So that's kind of a broad overview of whether or not you know a deal is a good deal from a return standpoint. For now, that will tell you what a good return looks like.